Hello, everyone. Thank you again for joining us for today's session. Sorry for a slight delay. I welcome you to this today's session on Central Bank Digital Currencies. Is this the future of money? I am Shehnaz Ahmed. I am a Senior Resident Fellow and the Fintech Lead at the Vidhi Centre for Legal Policy. Now, at Vidhi, when we first started our work on central bank digital currencies, it took us back to the fundamental question of what is money. Now, throughout history, we have seen physical tokens being used as money, with the recent manifestations being banknotes and coins. In most cases, these physical tokens do not really have an intrinsic value in itself, but people accept them as a means of payment with the hope and expectation and trust that they will be used by others. So the banknotes and physical tokens essentially derive their value from a common imagination or the collective agreement that we as a society have come to. Now, today, when a farmer sells perhaps his harvest in the market for a few banknotes, in exchange of a few banknotes, he knows perhaps that these banknotes may not really have any intrinsic value. But what he does know and trust is the fact that there will be others in the society who will be willing to sell goods and services to him in exchange of those banknotes. So perhaps what I'm trying to say here is that money is essentially based on a system of mutual trust. And history has shown us that money as a convention needs to be backed up by some sort of an institutional arrangement, which perhaps is best provided by an independent central bank. Now, over the couple of last years, questions have started to emerge in terms of how technological innovations will impact money and the payment systems. To a certain extent, digital money itself is not a new concept. I mean, we are all aware about commercial bank deposits being available digitally and being used for digital payments. Central bank money, to a certain extent, is digitally available for banks and financial institutions which hold accounts with the central bank. However, the latest innovations involve new forms of digital money. But rather than using commercial bank money as the basis for transactions, providers of new forms of digital money are innovating and trying to understand if they could use their own and issue their own money. Perhaps developments around stable coins have intensified these discussions. Now, central banks are not left behind. Central banks across several economies are in fact exploring the possible use case or possible issuance of a digital version of their fiat currency or national currency, which is now popularly referred to as central bank digital currency. Now, each of these developments that I have talked about right now has raised some very important questions about the basic architecture of money and its impact on the financial system. Now, to discuss these developments with me and to understand the future of money and its impact on the financial system and the monetary system, we have with us a stellar lineup of speakers. We will start firstly with the keynote address by Mr. T. Rabi Sankar, Deputy Governor of the Reserve Bank of India. This will be followed by a panel discussion with Mr. Saugata Bhattacharya, Executive Vice President and Chief Economist at Axis Bank, and Mr. Ashraf Khan, Senior Financial Sector Expert at the International Monetary Fund, and I'll be the moderator for the session. So without further ado, let me invite Mr. T. Rabi Sankar to please deliver the keynote address for today. Over to you, sir. Mr. Sankar, you're on mute.
Can you hear me now?
Yes, we can.
Thank you. Just a small clarification. How much time have you allotted me?
No, you can please go ahead with it. There's no such, it's up to you. We'll be waiting to hear you.
Great, thanks. What I propose to do today, I think you have given a very neat introduction about the nature of money, which is important because a lot of discussions happen today without a very clear definition, which is commonly understood across debaters, across participants, about what exactly is money, what exactly is currency, and what exactly is a central bank digital currency or a private virtual currency. I was thinking, I thought it would be a good idea to dwell a little bit on that to convey what I think is a currency or is a CBDC or is a virtual currency. But more importantly, to initiate better debate and therefore better awareness and better learning for all of us, about the nature of these innovations that are happening, whether CBDC or private currencies. I just wanted to clarify up front that in some places I have expressed my views, for example, on the nature of evolution of money, etc. Those are my personal views. They're not the Reserve Bank's views. So we would discuss that. Then I would go into some specific aspects that are important from the point of view of a CBDC. Essentially, that how does it interplay with the banking system? How does it interplay with monetary policy? How does it interplay with currency and other systems that we have? We would discuss. I would like to discuss that briefly, and end with generally what the Reserve Bank has been doing or what its thinking is in this respect. So, having said that, I think let me just start off. Probably I won't do justice to the subject itself. Is it the future of money? I have no idea. But is it one form of money that we are likely to see more of in the future? Definitely. Given the sudden increase in interest by central banks and other bodies across the globe. Okay, just by way of an introduction, the idea of central bank digital currencies may not really be a recent development. Some actually attribute the origins to James Tobin, a Nobel-winning economist, American economist, who in the 1980s, suggested that the Federal Reserve banks in the United States could make available to the public a widely accessible medium with the convenience of deposits and the safety of a currency. So we have the roots of what could be a central bank digital currency there. Yet, it's only in the last decade that the concept of digital currency has been widely discussed by central banks, economists, and governments, apart from private participants, especially in the technology sector. Now, except as currency notes, this is the state of financial system that we have, except for currency notes, all other uses of paper in the modern financial system, be it bonds, securities, transaction contracts, communications, confirmations, etc., correspondence, messaging, everything has been replaced from paper, to digital and electronic versions. People have told me, bankers who have traded earlier were telling me how they would come with, when they do bond trades, they come with those SGL forms, filling up the details, queue up in front of the Reserve Bank of India and settle those trades. Now, those things have gone pretty much, whether it's in the equity market or bond market or even in other markets. Except that currency has largely remained in its physical form. It's generally paper, but could also be other versions like polymer, etc. On anecdotal evidence, use of physical cash in transactions too has been declining in recent years, and this trend has been reinforced somewhat by the COVID-19 pandemic that we have had in the last year and a half. Now, these developments have resulted in many central banks and governments stepping up efforts towards exploring a digital version of a currency. Some of this interest among central banks has been indigenous in nature for pursuing specific policy objectives. For example, facilitate negative interest rates, in Europe and so on. So some advanced economies, central banks have been looking at this as one way of ensuring negative interest rates on currency. Another driver could be to provide the public with virtual currencies that carry the legitimate benefits of private virtual currencies, which are clearly increasingly being used, while avoiding any possible damaging economic consequences such as volatility that private currencies might have. But to go forward on this, as I said, we need to understand what is a CBDC. It's important to understand and appreciate what precisely is a CBDC. And to do that, as I said, one needs to understand what a currency is and what money is. What is currency? Let's start with money. As societies developed from hunters and gatherers, material needs increased to build a house, wear clothes, make weapons and implements. Since these needs could not be produced individually by the same person, people had to trade. They had to purchase things from one another. This purchase was paid initially by barter. Leather skins, cloak for a spear, for example. As barter had its limits, you had to transport the goods and access becomes a big constraint and so on. Barter got standardized gradually with the evolution of time. It got standardized in terms of metals and cowrie shells. Now, initially, now people knew the value of both the cloak and the spear in terms of the value of the bronze or the cowrie shells. I think there is somewhat of a misunderstanding that when we use these bronze and cowrie shells, they were representative forms of money, but they were actually commodities which had intrinsic value. The value of the bronze that was being paid to purchase, purchase a weapon or whatever. Shells, similarly, were desired for their beauty. So they did have intrinsic value, aesthetic value, perhaps not material value. Now, this system evolved over time into metal currencies. Gold and silver coinage were the offshoot of this system. Eventually, this is where they settled down. But even here, the intrinsic value of gold and the intrinsic value of the, of the commodity that is being purchased or sold with this gold had to be similar. So, in a sense, this is a hybrid of a gold, using gold coins or silver coins is actually a barter in that sense. But since they were standardized, you can look at them as hybrids of barter as well as representative money. Now, somewhere along the way, people improvised. Instead of actual goods for barter, they started using claims on goods, claims on commodities, a bill of exchange, in fact. Now, these could be clay tablets in Mesopotamia, which represented what was stored in a certain silo, what goods were sold, or they could be, paper currency as it happened in China in the 11th century. In fact, China started off, I think, pretty much in the 7th century with something similar to bills of exchange as well. So, two facts emerge very clearly from this historical development. One, money has taken the form of either commodities that have intrinsic value or in terms of debt instruments. This is important to understand. When money does not have intrinsic value, it has to represent title to commodities that have intrinsic value or title to other debt instruments. Paper currency is such a representative money, and it is essentially, you can look at it as a debt instrument. The owner of the currency knows who owes him or who has the underlying liability. So if you're looking at the rupee currency note, if I am holding it, I know that Reserve Bank owes me money. What that means is, of course, something else. But the statement that I promise to pay the bearer is in a sense an acknowledgement of debt. Can you just give me a minute? Please give me just 1 second. My apologies. Okay, so the owner of the currency knows who owes him and who has the underlying liability. In other words, there is always, I emphasize the word, there is always an issuer of representative money. Whether it is the government, which has what has happened, with evolution in the last 150 years, or whether it's a private bank issuing it or a trader issuing it like Italian banks, in the 15th to 16th centuries, one always knew who the issuer of that currency is. This is important to keep in mind, whose liability it is. The second point that emerges is that money is usually issued by a sovereign. Even when gold coins were issued, they were issued by kings, largely by kings or rulers. Private issuance of money, whether under sovereign license or otherwise, has existed in the past, but has over time given way to sovereign issuance for two reasons. Firstly, being a debt issuance, if you don't look at it as a commodity, with intrinsic value, you can look at it, as we said, as a debt instrument. Firstly, being a debt instrument, private money is as good as the credit of the issuer. So whether this makes private currencies unstable. This and the fact that there would be multiple issuers. It wouldn't be just one Italian banker or businessman who is issuing it. There would be 10 or 12 that would be issuing it. There would be multiple ones, and there would be a credit risk. Both of these add to some degree of volatility or some degree of uncertainty in the nature of a currency. On the other hand, public currency, as it is backed by sovereigns, is unique. There is only one to an economy and has better credit standing. It has the best credit standing in that currency because the issuing authority can simply print and issue. Therefore, it is far more stable, and that is what has evolved over time. Secondly, paper currency involves seigniorage. When you use representative currency, there is a difference in value between the intrinsic value of that paper currency and the value that it represents. And that intrinsic value, in a broad sense, accrues to the issuer, to the sovereign usually. This seigniorage ideally should not accrue to any private individual. It should accrue to the government and thus used for public spending. So there are two issues that come out when money is being issued by a sovereign. One is that sovereign issuance is more stable. Two, sovereign issuance ensures that seigniorage doesn't accrue to private entities or individuals. Both of them are socially more desirable outcomes. Now we are in a position, having gone through this brief introduction, we are in a position to provide a definition of currency. In modern economies, currency is a form of money that is issued exclusively by the sovereign or a central bank as its representative. It is a liability of the issuing central bank and sovereign, and an asset of the holding public. Currency is fiat, it is legal tender. Currency is usually issued in paper or polymer form, but the form of currency is not its defining characteristic. So that brings us to how would we go about defining a central bank digital currency. Now, a central bank digital currency can now be defined as the legal tender issued by a central bank in a digital form. What is being issued in paper form is now being issued in a digital form. It is the same as fiat currency and is exchangeable one-to-one with fiat currency. That is how I would define a central bank digital currency. There are variations. There are different uses from the point of view of which these definitions could differ. But fundamentally, I'm looking at central bank digital currencies as substantially no different from its paper currency, only its form is different. Now, a couple of points follow. It is important to understand what a CBDC is not. We have defined it as basically the currency, sovereign currency that is being issued in a digital form. Now we need to understand what it is not. CBDC is a digital or virtual currency, but it is not comparable to private virtual currencies that have mushroomed over the past decade or so. Private virtual currencies particularly sit at substantial odds to the historical concept of money. They are not commodities or claims on commodities, as they have no intrinsic value. Some claims that they're akin to gold seems to be opportunistic because gold has intrinsic value, at the end of the day. Usually, certainly for the most popular private currencies that are there, they do not represent any person's debt or liabilities. In other words, there is no issuer of a private virtual currency. Now, they are not money in the way that we have defined money, as money has been understood historically, that it either has to be a commodity or it has to be a title to a commodity, or it has to have an issuer like a debt instrument. So from those points of view, these private currencies many of them. There are many varieties, but certainly the more popular ones of them, as they do not have an issuer, they have no intrinsic value, they do not fall under the definition of a currency, as we have defined it. A line of argument that has helped private currencies somewhat to gain the status of a currency is the argument is that that most money in modern societies is in fact already private, since they represent deposit liabilities of private banks. Now, this is an argument that I've read in the speeches, etc., of certain central banks, very prominent central bankers as well. I think there are 2 points that such a line of argument is not really taking into consideration. One, deposits are issued by banks under license of the sovereign issuer of currency, usually the central bank. 2, deposits are accepted by the public, although this is not something that is explicit, but they are accepted because they are convertible one-to-one into sovereign currency. So a simple way to understand, I'm not saying it is legally and substantively this, a simple way to understand currency and deposit money is to look at deposits as lending of sovereign currency by the depositor to the bank for payment of interest, if it's an interest-paying deposit. Credit, its opposite side, is lending of sovereign currency. You can look at that as lending of sovereign currency by banks to the public on interest. Okay, so they cancel out on the balance. They are the ones which create the balance sheet. Bank deposits are money. Let's have no doubt about that. Bank deposits are money, certainly, but they have no independence existence as money, or more specifically currency. They are not an independent currency shown of sovereign authority and the resultant public confidence. So in any case, quite apart from we have dwelt at some length, because the statement that money, private money is already being used, is being used too lightly, I believe, in the discourse these days. I think that point has to be kept in mind. In any case, bank deposits are very different from a private currency, because bank deposits have an issuer, the bank. Private currencies don't. And bank deposits are convertible one-to-one with sovereign currencies. Private currencies are not. Okay. To sum up, CBDC is the same as currency issued by a central bank, but takes a different form, a digital form. It is sovereign currency in a digital form and would appear as liability, just like paper currency would on a central bank's balance sheet. The underlying technology, form, and use of CBDCs can be molded for specific requirements, but CBDCs would essentially have to be exchangeable at par with cash. So that is, that is what I thought it would be useful to understand how money has evolved, what exactly are the defining characteristics of money, and whether the various competitors measure up to those characteristics. Now let us go to the next question, that why is a CBDC required? What is the need of a CBDC in general? While interest in CBDCs now is nearly universal, very few countries have actually reached even the pilot stage in launching their CBDCs. 2021 BIS, Bank for International Settlements in Switzerland, Basel, BIS survey of central banks found that 86% of central banks were actively researching the potential of CBDCs. 60% were experimenting with the technology, and 14% were deploying pilot projects. Why this sudden interest? Most of it has happened in the last couple of years. So why this sudden interest? The adoption of CBDC has been justified for the following reasons. One, some central banks, faced with the dwindling usage of cash or paper currency, for example, Sweden, seek to popularize a more acceptable electronic form of the sovereign currency. there could be a fear that, I was listening to some talk from a Swedish official, and she was saying that, if this trend continues, then there probably would not be any Swedish krona available because no one would be using it. The idea is to keep that alive by issuing it in a digital form, hoping that it would be more acceptable. That's one. On the other extreme, you have jurisdictions with significant physical cash usage seeking to make cash use more efficient. India could be one of them, but there are other countries. Germany has a very high cash usage and so on. The idea there is, since there is a general preference for currency notes and they are in the form of cash, it would probably be more efficient to issue them in a digital form and reduced over-dependence on cash. So give them currency with all its features, but only in a different form. The third is basically, this is something that has been not been exactly spelled out by any central bank, but this is something that is there as a general idea in the debate that is going on globally now, that central banks seek to meet the public's need for digital currencies, manifested in the increasing use or discussion about private virtual currencies. And thereby provide a sovereign version of a virtual currency and try to minimize any damaging consequences of such private currencies. This could be another reason why central banks are, looking at developing their own CBDCs. In addition to these three, broader arguments of why central banks might go for digital currencies, CBDCs have some very clear advantages over other digital payment systems. Payments using CBDCs are final and thus reduce settlement risk in the financial system. Imagine a UPI system. Most of you would be familiar with the UPI system. It's real time. Everything is fine. What you don't realize is that the transaction isn't settled. There is, there is a background settlement that happens between banks in the books of the Reserve Bank of India. Only then are the transactions final. So imagine a UPI system where CBDC is transacted instead of bank balances. Today it is between bank balances. Where CBDC is transacted instead of bank balances, and as if cash is handed over, the need for interbank settlement disappears because it is final. It is central bank liability being handed over from one person to another. CBDCs would also potentially enable a more real-time and cheaper globalization of payment systems. It is conceivable for an Indian importer to pay, let's say, its American exporter on a real-time basis in digital dollars without the need of an intermediary, as long as both the digital systems are connected. This transaction would be final, which means, as if cash dollars are handed over, which means that one would not even require that the US Federal Reserve settlement system is actually open at that point in time. Okay, those of you who understand risk in foreign exchange transactions would appreciate this. The time zone difference in currency transactions would virtually disappear. What is called Hurst risk would no longer exist if you can actually transact in digital currencies between two countries, both of whom have this digital currency. So these are some of the benefits. There are many. There could be many other benefits, but these are some of the very clear benefits that spring to mind for we justify why CBDCs would be required. We come to the next question that yes, they are required. Would they be required in India? Do we think CBDCs are required in India? Now we have discussed these advantages. Those advantages are advantages that could also accrue to us in India if CBDCs were issued. Although for the benefits to global settlements to accrue, it is important that both the countries in a currency transactions have CBDCs. In fact, this is one thing that has been highlighted by BIS, by Christine Lagarde, that it is important that all central banks get on the CBDC arrangements and coordinate effectively with themselves to actually maximize the immense potentials that CBDCs carry. Okay. Now, anyway, coming to India-specific factors, India is leading the world in terms of digital payment transactions, innovative digital payments transactions. Its payment systems are available 24/7. They are pretty much real-time for both retail and wholesale customers. The cost of these transactions is perhaps some of the lowest in the world, if not the lowest. Users have an impressive menu of options to undertake any particular transactions. And digital payments, because of all these factors, are growing at a staggering, CAGR cumulative average growth rate of 55% over the last 5 years. It would be actually difficult to find another payment system or another country with a payment system like UPI that even allows the transaction for 1 rupee. With such an impressive progress of digitization, is there a case for CBDCs? In other words, what is the need that CBDC addresses that these payment systems cannot address? A pilot survey conducted by the Reserve Bank on retail payment habits of individuals in 6 cities between 2018 and December 2018 and January 2019, results of which were published in the April 2021 RBI bulletin, indicates that cash remains the preferred mode of payment and for receiving money for regular expenses. For small value transactions, usually up to 500, cash is actually used predominantly, even today, or rather, 18-19, when the survey was done. There is thus a unique scenario of increased proliferation of digital payments in the country, coupled with sustained interest in cash usage, especially for small value transactions. To the extent the preference for cash represents a discomfort for digital mode of payment, CBDC is unlikely to replace such usage. But preference for cash for its anonymity and other significant factors that account for the demand for paper currency, such preference can be redirected to acceptance of CBDCs, as long as anonymity is assured. Now, India's high currency to GDP ratio, India has a fairly high currency to GDP ratio. High currency to GDP ratio holds out another benefit of CBDCs. To the extent large cash usage can be replaced by CBDCs, the cost of printing, transporting, storing, and distributing paper currency and coins can be substantially reduced. The cost of the currency system could be substantially reduced. The other one we have already agreed, the advent of private virtual currencies is another reason why it might become necessary. It is not clear what specific need is met by these private virtual currencies that official money cannot meet. In fact, this is one of the arguments made by another Nobel-winning economist, Paul Krugman. That is not clear, but that may in itself not come in the way of adoption or popularity of these private currencies. If these private currencies, virtual currencies, gain recognition, national currencies with limited convertibility are likely to come under some sort of a threat. To be sure, freely convertible currencies like the US dollar may not be affected at all, or significantly, as most of these virtual currencies in any case are transacted and denominated in terms of, for example, the US dollar. In fact, these VCs might actually encourage the use of US dollar, as has been argued by Randall Qualls recently in a speech. Developing our, I would put this speech in the public domain. We would provide the necessary references. So if I'm saying anything here for which you don't have a reference, it can be accessed. We'll try and put it up today, so you should be able to access it quickly if you desire. Developing our own CBDC could provide the public with uses that any private VC can provide, and to that extent might return public preference for the rupee. It could also protect the public from the frightening level of volatility some of these virtual currencies experience. Indeed, this could be the key factor nudging central banks from considering CBDCs as a secure and stable form of digital money, for which there clearly is interest, if not demand. I was talking about Christine Lagarde. This is what she has to say. The central banks have a duty to safeguard people's trust in our money. Central banks must complement their domestic efforts with close cooperation to guide the exploration of central bank digital currencies, to identify reliable principles and encourage innovation. I'm quoting her. The case for CBDCs for emerging economies is thus fairly clear. CBDCs are desirable, not just for the benefits they create in the payment systems, but also might be necessary to protect the general public in an environment of multiple, some of them very volatile, private virtual currencies. Now, having established, presumably the reasons why we should, especially as an emerging economy with not an entirely freely floating currency, I think now we need to look at, if we have to introduce it, what could be the possible issues that we need to grapple with. I will just focus on some of the more important ones. One is CBDC and the banking system. Now, CBDCs, depending on the extent of their use, can cause us reduction in the transaction demand for bank deposits. That's fairly clear. Since transactions in CBDCs reduce settlement risk as well, we have discussed that, they reduce the liquidity needs for settlement of transactions. For example, intraday liquidity on RTGS. In addition, by providing a genuinely risk-free alternative to bank deposits, they could cause a shift away from bank deposits, which in turn might reduce the need for government guarantees on deposits. This is something that has been argued in some academic papers. At the same time, and these are some of the benefits that could accrue, at the same time, reduced intermediation of banks carries its own risks. If banks begin to lose deposits over time, their ability for credit creation gets constrained. Since central banks cannot provide credit to the private sector, the impact on the role of bank credit needs to be very well understood before these instruments are issued. Plus, as banks lose significant volume of low-cost transaction deposits, their interest margins might come under stress, leading to an increase eventually in the cost of credit. Thus, potential costs of disintermediation mean it is important to design and implement CBDC in a way that makes the demand for CBDC vis-a-vis bank deposits more manageable for the system. Even if it is difficult to a priori understand how public behavior might change, it is important for policymakers to ensure that such change happens at a rate slow enough for the system to adapt efficiently. There is another risk of CBDCs that could be material. Availability of CBDC makes it easy for depositors to withdraw balances in case a bank comes under stress. Flight of deposits can be much faster compared to withdrawal of currency notes. On the other hand, this is something that could happen. If a bank comes under pressure, money could flow out very quickly from the bank. But on the other hand, just the availability of CBDCs might reduce panic, because depositors have knowledge that if required, they can actually withdraw very quickly. Okay, so one consequence could be that banks would be motivated, given this risk, banks would be motivated to hold a larger level of liquidity, which could again result in slightly lower returns for commercial banks. Now, these are some of the risks and returns of for the commercial banking system. In actual fact, notwithstanding the benefits of CBDCs vis-a-vis bank deposits, since CBDCs are currency and therefore do not pay interest, their impact on bank deposits actually might be rather limited. Depositors that require CBDCs for transactional purposes, in all probability, will enter into arrangements where the unused currency is swept into bank deposits at the end of the day. So if that actually happens, then banks may actually not end up losing, as much deposits as it could be feared. Secondly, CBDC and monetary policy. What impact it will have, because it's a new form of money. We do not really know how behavior will change of economic agents. So what impact it might have on monetary policy. That is not actually very clear. CBDC may bring about a change in the behavior, and what that behavior we of course don't know. But if there is an overwhelming demand for CBDC, and CBDCs are issued largely through the banking system, which is the likely scenario, more liquidity may need to be injected to offset the currency leakage from the banking system. Okay, so banks would probably, the demand for central bank liquidity from banks would probably go up if the use of CBDC goes up. This is one thing that could affect how monetary policy transmits. Much recent discussion has focused on the use of negative interest-bearing CBDCs for effectiveness of monetary policy for a specific reason. The extremely low inflationary environment in Europe or Japan or some similar advanced economies has constrained their ability to reduce interest rates beyond zero, below zero, because any reduction in interest rate on bank deposits there would drive deposits away to cash. So that would have consequences that would be difficult to manage. However, monetary transmission of negative policy rates to boost demand could be more effective if currency itself can carry a negative interest rate. So if you, instead of paper currency, if you have digital currency and you could program those currencies to carry a negative interest rate, then the move away from bank deposits to CBDC to currency will not happen. And to the extent it does not happen, sub-zero interest rates, negative interest rates can actually be used as an important policy tool by central banks if required. That is something, especially from these advanced economy central banks, that is one of the drivers for CBDC. But such steps may be taken with care, as again, in my view, any instrument that pays interest, positive or negative, is strictly not a currency. To the best of my ability and my understanding, currency has never paid interest. In fact, not paying interest is what, because it is perfectly liquid, not paying interest is what distinguishes currency from non-currency financial assets. Anyway, the third point is, of course, the next point is CBDC and technology risk. Most of you would understand that CBDC ecosystems may be at similar risk for cyber attacks as payment systems are exposed to these days. Further, in countries with low financial literacy levels, the increase in digital payment related frauds might also percolate to CBDCs. Ensuring high standards of cybersecurity and parallel efforts for financial literacy is therefore essentially for any country dealing in CBDCs or thinking of introducing CBDCs in a big way. Absorption of CBDCs in an economy is also subject to technology preparedness. The creation of population scale digital currency system is contingent upon the availability of high-speed internet and telecommunications networks, and ensuring the wider reach of appropriate technology among the general public, or at least come up with use cases which can work offline, which can work on feature phones and so on, even for these currencies. So technology has to evolve simultaneously. In countries with lower level of technology, adoption of CBDC to that extent might actually be limited. Now, I will very briefly talk about RBI's approach to CBDC. Now, central banks across the globe are engaged in exploring CBDCs, and a few countries have also introduced proofs of concept, as we said, and pilots on CBDCs. In India, the high-level interministerial committee, constituted in the Ministry of Finance, has examined the policy and legal framework and has recommended the introduction of CBDC as a digital form of fiat money in India. Like other central banks, RBI has also been exploring the pros and cons of introduction of CBDC since quite some time. Generally, countries have implemented specific purpose CBDCs in the wholesale and or considering implementation of specific purpose liquidities, CBDCs in the wholesale and retail segments. Going forward, after studying the impact of these models, launch of a general purpose CBDC, which is population scale, can be considered. RBI is currently working towards a phased implementation strategy and examining use cases which could be implemented with little or no disruption. I'm referring to the impact that it could have on the banking system and the impact that it could have on monetary policy. The idea is to start off with, with models that would have minimal such impact and no impact if it can be helped. Some key issues that are being examined are the scope of CBDCs, whether they should be used in retail payments or should they be used in wholesale payments. The underlying technology, whether it should be a distributed ledger or a centralized ledger, or whether different use cases can use either of these two to be more efficient. The validation mechanism, whether it should be token-based or account-based. The distribution architecture, whether it will be issued directly from RBI or through the banking system, degree of anonymity, etc. These are some of the issues that we are looking at very closely now and studying them. However, conducting pilots in wholesale and retail segments may be a possibility in the near future. So some progress has been made. We could likely come out with this in the near future. This is, Vidhi is a legal entity, so there's not much that I need to tell regarding the legal framework, but we have also had a look at that internally. But although CBDCs are conceptually no different from banknotes, introduction of CBDC would require an enabling legal framework, since the current legal provisions are made keeping in mind currency in a paper physical form. Under the Reserve Bank of India Act, the bank is empowered to regulate the issue of banknotes in the preamble itself, and the Reserve Bank derives the necessary statutory powers from various provisions of the Act with respect to denomination from Section 24, with respect to the form of banknotes from Section 25, or the status of legal tender in Section 26, etc. There is a need to examine, if CBDC has to be introduced, some sort of an amendment to these provisions is required. There is a need to also examine consequential amendments to the Coinage Act, to FEMA, and of course the Information Technology Act. These are some of the things that we are looking at internally. Even though CBDCs will be a primarily technology-driven product, it will be desirable to keep the legislation technology neutral, to enable coverage of a wide variety of technology choices. That's pretty much it. I would now just conclude with a few remarks. Introduction of CBDC has the potential to provide significant benefits, such as reduced dependence on cash, higher seigniorage due to low transaction costs, or even probably higher use of currency in digital form, reduced settlement risk, and so on. Introduction of CBDCs would possibly lead to a more robust, efficient, trusted, regulated, and legal tender-based payment system. There are associated risks, as we have discussed, but they need to be carefully evaluated against the potential benefits. It would be RBI's endeavor as we move forward in the direction of India's CBDC to take the necessary steps which would reiterate the leadership position of India in the payment systems environment. CBDCs are likely to be in the arsenal of most, if not every central bank going forward. Setting this up will require careful calibration and a nuanced approach to implementation. Drawing board consideration and stakeholder consultations are important. As far as we are concerned, they're either happening or will happen going forward. Technology challenges have their importance as well. As they say, every idea will have to wait for its time perhaps the idea for CBDCs is near. Thank you. I'll stop here.
Thank you so much, Mr. Rabi Sankar. I think there could not have been a better context setting for this session. I think you have touched upon almost each and every point that I think is very, very crucial to understand CBDC issuance, right? From tracing how money has evolved over the course of years to what perhaps are certain policy motivations that are necessary for considering CBDC issuance, plus challenges and its potential implications on existing systems. I think that's something which will be very useful, in fact, to set the context for the upcoming session that we are having on central bank digital currencies. And thank you also so much for highlighting India's perspective and India's approach towards CBDC issuance. Once again, on behalf of the Vidhi Centre for Legal Policy, I really thank you for taking out the time for this session. And thank you so much for your insights and comments. Thank you so much.
Thank you very much. It's it's a privilege to have talked about this in front of an audience which is obviously very highly aware of the issues. I wish further discussions and all happen. All success for those things, and I wish that some very useful and practical suggestions could come out of these discussions. We would be happy if you keep us informed of these discussions and any conclusions that is reached from those. Thank you. I'll take your leave.
Thank you. Thank you so much. So before we go to our panel discussion, we'll kind of give a brief presentation about Vidhi's work on central bank digital currency. So we have released a working paper on a central bank digital currency for India, proceeding with cautious optimism. I think a lot of points Mr. Rabi Sankar has already touched upon, so I'll not take much of your time on this, but we'll quickly go through that. Just give me a second as I try to share the screen. Sure. So as we have already talked about in terms of how several central banks across various economies are trying to explore a possible use case for central bank digital currency. Now, what Vidhi's paper essentially does is that it deconstructs CBDC. It traces CBDC developments in 43 countries. It examines policy motivation and challenges for CBDC issuance. It identifies preliminary consideration for issuance of a digital rupee in India, and it discusses the legal foundations of CBDC issuance in India. Now, what is a central bank digital currency? I don't think I'll get into that. Mr. Rabi Sankar has already kind of given us an example. Now, in terms of if I have to kind of explain it in the simplest terms in terms of how a CBDC may look like for the general public, it may essentially be in the form of a wallet where central bank funds can be stored, which can be used for the purposes of making payments. It can be as in the form of an account, which can be held perhaps at the central bank. So these are like some very simple ideas in terms of how a CBDC may look like. There are certain countries which are looking at pilots. For instance, China has already done a pilot last year on CBDCs. The Bahamas has already launched a digital version of its dollar. But I'm sure our panelists will have to kind of comment on this. I'm not getting into the details. Quickly moving on. So as I had mentioned, we had reviewed certain jurisdictions in terms of the CBDC developments. What we did note was that most jurisdictions have a positive stance towards CBDC issuance. Most jurisdictions are looking at a retail central bank digital currency. That is a digital currency that can be used by general public. And there are certain countries which are also kind of experimenting with wholesale central bank digital currencies that primarily focus on cross-border payments. As in terms of important consideration for issuance of a digital rupee, I think the first question itself is the primary motivation for issuing a digital rupee. So what the Vidhi paper does essentially is that we have taken up some common identified policy motivations and we have tried to examine them from the perspective of India. The second point is in terms of what are the features of central bank digital currency. Now, this I think it will be very important to understand how the CBDC will interact with existing payment solutions and its impact on the financial system. So some important questions perhaps will be whether it will be facilitate real-time payments like UPI or IMPS, whether it can be converted into other forms of money like bank deposits or cash, whether it will be interoperable with existing payment solutions, whether it will bear interest like bank deposits, whether there'll be a limit on the CBDC funds that can be held. So these are some very important questions that are there. The third point is in terms of what will be RBI's role. Now, when we talk about a retail central bank digital currency, it will mean that it will lead to introduction of several services for the public. The question is whether RBI will have institutional capacity to manage this on its own, or will it require the involvement of certain other financial sector intermediaries for the purposes of the CBDC ecosystem. So that's the third point that we are looking at. And last but not the least, the legal foundations. Now, I think this is perhaps one of the most significant considerations in the issuance of a CBDC, because technology itself cannot create money. It has to be backed by some sort of a robust legal framework. And as Mr. Sankar had already mentioned, that currently the law perhaps does not exactly expressly provide RBI with the power to issue a digital currency. So that's something that has to be revisited. The second question is whether CBDC should be granted a legal tender status. So typically under most laws, banknotes or cash is given a legal tender status in the sense that payment in banknotes is recognized as a valid discharge of your debt. Typically, such legal tender is given to a form of payment instrument which is easily accessible by everyone, which can be easily used by everyone. Now, if we look at a central bank digital currency, it will require access to digital infrastructure. So in certain countries where perhaps there may be disparities insofar as access to digital infrastructure is concerned, will it be fair to kind of confer a legal tender status on central bank digital currency is also a question that can be pondered upon. If CBDC ecosystem involves intermediaries, regulations governing such intermediaries will have to be thought upon. Then last but not the least, implications of CBDC issuance on other laws. Privacy concerns emanating from CBDC is a huge issue, is a huge point of discussion among central bankers. So its implication under data protection laws is something that needs to be thought about. The implications of CBDC issuance on prevention of money laundering laws relating to counterfeiting of notes and currencies is something that perhaps will have to be considered upon. So these are some of the issues that we have dealt upon in the report. If you want to read the report in details, you can visit our website. I'll also request my team to put up a link to the report here and an explainer video that we had prepared in terms of what a CBDC is. With the link to that will also be put up on the chat box here. So without going into further details, I'll now quickly proceed to the panel discussion. First of all, I think I'll move to Mr. Khan here. Mr. Khan, you have kind of worked upon your tracking CBDC developments in different countries. And in fact, the IMF paper that you have co-authored on the survey of central bank digital currencies is something which has been very useful for us in informing our research. So can you give us like a brief overview of the CBDC developments in different countries?
Yes, thank you so much, Shehnaz, for that question and also for inviting me to join this panel. And thank you obviously to the Deputy Governor for the very interesting and clear presentation on CBDC from the RBI's perspective. Now, similarly, first I need to stress that any comments from my side reflect my personal views and cannot be attributed to the IMF, its board or its management, and I thank you for your understanding. Second, your point on CBDC developments across the globe, I think it's quite clear, as the Deputy Governor also pointed out, there has been a significant increase in central banks examining CBDC in one form or another over the past years. Even if you do a quick Google Trend search, you show that especially after December 2019, search interest for CBDC started picking up. And key searches emanated from South Korea, Hong Kong, China, Singapore, and searches conducted on those topics related to currency, crypto, Bitcoin, and importantly, CBDC meaning. So though this is of course far from, let's say, indicative of the work that central banks are doing, these search results do provide anecdotal evidence of some kind of, set of issues that the concept of CBDC is facing. So how is a CBDC different from, let's say, normal currency or from cryptos, and what does CBDC actually mean? Also, and I think there were some references in the chat already, with the increasing popularity of stable coins, which the name itself already has a more stronger positive connotation than CBDC, it becomes more difficult to explain the differences to the general public. And in fact, stablecoin has overtaken CBDC in many Google searches. Now, we see this dichotomy reflected in how central banks across the globe are dealing with CBDC as well. So roughly speaking, I think there are three main groups. So you have the central banks conducting research and analysis. You have the central banks conducting limited or ring-fenced pilots. And you have central banks that are actually embarking on live pilots. Now, there are a number of CBDC trackers out there. Most of them are based on the limited sources that are there. So news articles, publications, and central banks are obviously, for understandable reasons, somewhat hesitant in sharing everything that they're exploring right now. But I think in general, you can see that CBDC pilots are, not really in the launching phase. There's one that is clearly launched. You referred to it already just now, which is that of the Bahamas Sand Dollar. And there are another 5 retail pilots that are ongoing. I think it includes Kazakhstan, Jamaica, the ECCB, China, and Uruguay. Or Uruguay, I think, was already concluded earlier, as well as 7 proofs of concepts, including Sweden, Japan, and Ukraine, and a whopping 35 central banks or so that have announced pilots. Some are more in the exploratory phase. I think India falls in that category, as the deputy governor pointed out. And just last week, the European Central Bank. So 6 central banks have already explicitly canceled their retail CBDC pilots. Interesting enough, I think one of the CBDC trackers includes the Avant pilot of the Bank of Finland, which was launched back in 1992 already, and which was based on smart card technology operated by the central bank, but then overtaken by commercial bank debit cards and their popularity. So I think, summing up in response to your question, it definitely shows that CBDC approaches are very likely here to stay, but the specific form, shape, and importantly, the associated risks, have not come to full fruition yet, if you will. Let me just stop right there.
Thank you so much, Mr. Khan. Mr. Bhattacharya, I turn to you. Mr. Khan, give us an overview of CBDC projects in different economies. Now, we know that CBDC issuance is being considered by both emerging markets as well as advanced markets. Now, in the context of an emerging market like India, what do you think are certain policy motivations that will drive CBDC development?
So again, thank you so much for this opportunity of joining this very, very interesting discussion. Deputy Governor was very, very comprehensive, so I don't really know how much more I can add to this. But from a banking sector perspective, I don't speak for my institution, these are personal views. Okay. So one, of course, this is an idea, a concept whose time has come, no doubt about it, because the technology already exists, distributed ledger, blockchain technology. So if the central banks don't do it, somebody else will do it for them. So this needs to be done. India, as Deputy Governor mentioned, the rise in digital transactions, the digital platforms, has been enormous. All the retail electronic transactions and so on have risen by a huge amount, but at the same time, cash also remains relatively high. CBDCs definitely needs to be considered as a central bank public good. Just like Governor mentioned that the yield curve has become a public good. As of this point in time, CBDCs can also. So basically, CBDCs, as everybody has mentioned, it's exactly like banks keeping the reserves with the central bank. Only with CBDCs, you have multiple added functionalities. So you can have conditional payments, etc. So reduces the risk to a very large extent. This also obviously changes the conventional 2-tier payment systems from the central bank to wholesale institutions, banking institutions, or to retail. How does that work with what are the motivations? Obviously, there are multiple areas that I'll get into a little bit later. The role of distributed ledgers, blockchains in trade finance, cross-border trade finance, say for instance, that's increasing. So something like that, with coordinated across multiple central banks, etc., will have multiple effects. Financial inclusion is something that all of us have read, that there might be benefits. Although I'm not immediately very convinced on the role of financial institutions, because that enabling ecosystem needs to be put in place. So you need to measure this in terms of accessibility. So I might have a digital currency in my wallet. What do I do with it in remote areas, rural areas, the low-income families? So accessibility of the operating ecosystem for the digital currencies. Plus, on top of that, the arguments for efficiencies, as we just heard. With multiple features of the digital currencies, it might become more efficient in terms of transactions, and obviously as part of the efficiency argument, the cost. Really, I haven't, and these are obviously, I mean, and this is a retail CBDC for the financial inclusion side. So, I mean, as Mr. Khan also mentioned, I mean, these are all pilots now. I mean, it's a long way to go to understand the impacts of this. Obviously, I mean, in the digital payment space that India has now had, we've had significant, I mean, huge improvements in reaching the last mile in terms of CIBIL scores, in terms of ability to deliver credit to small and micro businesses, the enormous generation of data that has now come in. So, I mean, obviously, if the digital payments using conventional payments systems, that has had an impact, and certainly digital currencies could potentially have an impact. So let me stop there, and other issues need to be.
Sure. Thank you so much. I think I also completely agree with you insofar as the policy motivation behind financial inclusion is concerned. Unless I think the socioeconomic factors or the accessibility issues, which today also exist in India insofar as digital payments are addressed, unless those are addressed, I'm not very sure to what extent CBDC will be able to promote financial inclusion. Turning to you, Mr. Khan, now when we look at policy motivations for CBDC design, we know that it is closely linked to the stage of perhaps economic development of a country, and perhaps also the depth and breadth of the financial sector of that country. So now I would basically want to discuss with you, when it comes to the issuance of CBDC, what are some of the approaches that are being adopted in different economies?
Yeah, so this is a really good question, and I think everybody wants to know, how do you, implement, what kind of approaches do you set up? But I think, as you, Mr. Bhattacharya, and the Deputy Governor just already noted, is you really need to take a step back and ask, why would you be considering a CBDC? And we've heard, things like financial inclusion and payment system stability, but like anything else, a CBDC is a tool, right? So it's not a goal on its own. So if you do not ask the question first, why would I be considering this CBDC? The design and the approaches of a CBDC might likely also be all over the place. Now, and I think that is something that central banks really need to think about more closely. So the objectives, I think, if you leave the wholesale component out, I think many central banks are seemingly exploring retail CBDC, as was just mentioned, to enhance financial inclusion. Especially in those regions where geographical hurdles would limit easy access to regular cash. We also heard the argument for cross-border payments, facilitating inter-country trade, inflow of worker remittances. And some central banks are also attracted by the modular approach, so allowing money to have conditions such as transaction limits, monitoring elements, as was mentioned just now from an AML, CFT, and KYC perspective. I think the Deputy Governor also highlighted that there are countries, obviously, that do not have their own currency, where the country is heavily dollarized, and they see possibilities for actually regaining traction, and thereby also of seigniorage of a domestic currency in the form of a CBDC. Increasingly also, and there was an interesting paper published yesterday by the Bank of Canada, we see additional arguments that go beyond the realm of the central bank, which tie into competition and innovation in general in the digital payment markets. And lastly, I think, and we should not underestimate this also, I think there are also a number of central banks that are attracted to the novelty factor of CBDCs. I've had interactions myself where the discussion on CBDC seemed to have been instigated more due to the fact that it's a hot topic on central bank conferences, rather than because of the immediate and clear added value to the respective central bank and its objectives. And that makes it also difficult to base CBDC pilot development on just press releases or speeches alone. Now, I do want to stress that even this novelty factor is, of course, not bad. Instead, it has, I think, inspired many central banks, and that's why we're talking about this right now also, to conduct research within their own jurisdiction, and might have even helped spur further innovation in the payments realm in general. Like Mr. Bhattacharya just pointed out already, if you have these developments going on already, a discussion of a CBDC can help further that, but doesn't necessarily need to validate the need for a CBDC. However, I think because of this variety of central bank objectives for CBDCs, the approaches applied by those few central banks that have actually moved into pilots also very much differ. If you do want to come up with a general kind of summary of approaches, most of the very limited central banks that are working with CBDC solutions now use external commercial vendors. And these vary also from established printing works, so the paper note printing factories that have moved into the digital domain already quite some time ago, to new fintech entrants, and also to consulting firms working with other tech partners. Now, given that central banks are generally very risk averse, many of the pilots or the planned pilots are also taking place in very controlled environments, such as a sandbox, and not just having a general rollout of the CBDC. And they often involve, again, from a risk perspective, domestic financial entities that are subject to supervision and regulation. And I think, Shehnaz, you touched upon that in your own presentation. Again, you want to have entities where you can ensure that the public keeps trust in a CBDC and trust in the central bank and trust in the domestic payment system as well. So what is all similar to all of these approaches is that non-financial risks that central banks expose themselves to with CBDC pilots are strongly increasing as well, regardless of the objectives of the CBDC or the specific solution. So I understand it's a bit of a beating around the bush answer. There's no one approach because there's no one objective. And that's the chicken and egg question that is on the table. You go for the design and the approach, or do you first examine what am I trying to achieve? Let me just stop right there.
Sure. Thank you so much. I think we've talked about the policy motivations, perhaps some of the approaches that central banks are talking about. Now, while CBDC may offer several opportunities for improving the efficiency of the existing payments ecosystem, or even promote financial inclusion, as we have heard today, it is no doubt that central banks still remain wary about the implications of CBDC on their financial system and monetary system, particularly perhaps about its impact on the disintermediation of the banking sector. I think the Deputy Governor already touched upon some of these points. Now, of course, these concerns are quite valid, considering the novelty and complexity associated with the concept of CBDC itself. Mr. Bhattacharya, I turn to you now. Could you outline for us some of the impact of CBDC issuance on the financial system, the banking sector, and especially since a retail central bank digital currency will actually see RBI introducing services for retail users?
So yeah, I mean, very, very interesting set of issues that we have here. So one, CBDC or not, banks are already under a fairly significant threat of disintermediation. So the fintechs have, for instance, have already disintermediated banks from a large segment of the payment space. So banks used to have a fairly high returns on the payment function. No longer, payments are earned zero fees now. So that's one. Second, in terms of banking disintermediation in particular, I had referred to this in terms of cross-border trade. The systems were fairly inefficient before, before some of these new distributed ledger technologies came in. I mean, companies like Ripple, like TransferWise, etc. I mean, now you have almost pretty much real-time settlement systems instead of the 2-3 days it used to take because of the multiplicity of systems talking to each other and so on. The interesting question now, because despite all the payments, banks are still the sole repository of deposits in the system. Whether you invest your money in mutual funds and stocks and bonds or whatever, at the end of the day, it comes to a bank deposit. What happens if retail investors, retail depositors deposit directly with the central bank? Now, I have a somewhat different take on this. This is a very interesting issue, which Deputy Governor also mentioned. Look, I mean, banks are already relying to a very large extent on central banks for their liquidity. I mean, it's some form of a deposit. It's a wholesale deposit that banks already globally because of the central bank liquidity infusions. So what happens if banks do not have to go directly to depositors, but can, and we need to design that system, that banks can access deposit equivalent as the liquidity that the central bank has with the direct deposits from retail depositors. So obviously pricing becomes very important, pricing of these deposits. My sense is it actually might be a better system. I mean, I'm talking of a long way down when the central bank deposits become large enough for banks to be actually losing deposits. Just like now, in the current liquidity constrained environment, that is to say, I mean, the central bank providing liquidity, why can't banks directly take money that has been deposited. Pricing, of course, is a very major issue. This might actually have important implications for costs of getting bank deposits. If you do not have branch networks, say for instance, I mean, you take the money directly from the central bank, it actually reduces the cost of taking deposits. So that actually might help to make lending, because lending is a pure bank function, bank, NBFCs, whatever. I mean, financial intermediate function. So this is something which needs to be explored. How that might actually happen. Remember that banks already take wholesale deposits, bulk deposits from large institutional players without a branch network. I mean, so that already happens. So that becomes a very important part in all of this. Again, I mean, let me stop at this. But I think the last question that you had in terms of retail, how retail investors interact with the central bank. I think retail investors, retail depositors already interact. I mean, in terms of grievance redressal, I mean, the ombudsman system, which is a RBI function. And now the RBI will be opening up accounts for buying and selling bonds directly from the central bank. So that mechanism already exists. And this is just one step ahead in terms of the retail interaction with central banks. Thanks.
Thank you so much for this interesting perspective. So Mr. Bhattacharya touched upon the impact of CBDC issuance on the financial sector. Now, however, issuance of a retail CBDC would also mean that central banks have to embark upon new activities even within the central bank itself. There will be several factors, there will be certain risks that needs to be considered. Mr. Khan, I turn to you now. Could you highlight what are some of the key risks perhaps that central banks will have to consider before embarking upon a CBDC issuance?
Yeah, thank you, Shehnaz. And again, that's a very good question. So I think, there's a distinction here, right? So we just talked about, risk to the financial sector as a whole. But I think one of the areas that is, I say that carefully, sometimes overlooked by central banks is the risks that they run themselves. And again, I stress that especially non-financial risks are an increasing area of concern for central banks. Because there's simply, not that much in the picture as the financial risk that the central bank runs itself, either from a balance sheet perspective or because of its activities in general. Now, together with my IMF co-author, Majid Malaika, we recently wrote an IMF paper on central bank risk management, fintech, and cybersecurity. And those non-financial risks that we identified in the paper, they include a very large bucket of strategic, policy, operational, reputational, and, as you pointed out, also legal risk. That's partly because central banks are often not equipped, as the deputy governor also hinted at, to do proper cybersecurity assessments of, let's say, the external vendor that they might be using for their CBDC solution, and they need to rely on outside expertise. So even though, as I think we pointed out, a CBDC is very much in the realm of central bank operations, and as Mr. Bhattacharya pointed out, these digital developments have already been taking place in so many other areas. It does not necessarily mean that central banks are adequately equipped to deal with the risks. Also because central bank decision makers at the very top, the board level, the governor's level, who are ultimately accountable for the CBDC project, are not always fully in the loop or sufficiently sensitized, if you allow me to say that, to offer proper oversight. Because these developments are going so quickly, and there's often a lot of technological understanding needed to provide that oversight. Also partly because the central bank's own internal control and assurance, through its risk management, internal audit, might be operating more at an arm's length from the specific CBDC project. Now, I think already those couple of central banks that are doing controlled rollouts within their existing legal and regulatory framework, and that's also a good point that you brought up, with regulated and supervised entities such as commercial banks, they will generally be able to ensure risk can be identified and mitigated more quickly. And it seems like a good approach, but it does force the central bank to carefully and explicitly manage expectations of its stakeholders. Now, we heard the deputy governor also say at the end that stakeholder management, outreach to stakeholders for a CBDC pilot, even in the Indian context, is very relevant. But it's also about timing. You would not necessarily do that when you're already embarking on a rollout, right? So here also enhanced tools and instruments such as the CBDC. There's a need for the central bank, the RBI, towards the Indian society in general, to be very transparent and accountable over what it does or is planning to do. And again, that holds for all central banks that are embarking on these pilots. Now, I think there are 4 or 5 key things that they can do to mitigate these risks. First, the central bank has to have very strong risk management internally, a dedicated risk management function which can identify CBDC-related risks and assist in the mitigating and reporting of and monitoring of those risks. Again, this is not a hallelujah scenario where only the positive sides get highlighted. And central banks are generally aware of those risks, but they need to institutionalize that more strongly within their organization. Second, and I alluded to that already, central bank decision makers, governors, executive board members, non-executives, they need to have updated fit and proper requirements for themselves, similar to what they roll out as a supervisor over the financial sector, in the sense that they need ongoing training on relevant CBDC developments for them, but also for central bank staff. And in most cases, again, due to the fast-moving nature of fintech developments, that's not institutionalized in central banks now. You'll have a very limited pilot group, limited expertise working on this, kind of standalone from the rest of the central bank. So third, and that ties into this, you need to have clear and swift reporting lines within the central bank on CBDC issues from all relevant departments. So the monetary policy MONOPS part, the economic research, financial stability, supervision, internal organization, they all need to work seamlessly. And many central banks, especially in the larger countries, are, kind of set up in very siloed manners, and that's not conducive to fast-moving developments such as CBDC or fintech in general. Fourth, the central bank needs to incorporate the CBDC, and this touches upon the point we discussed of the objectives, into its mid to long-term strategic plan. This is not a standalone solution. If you do not know the objectives right now, or you're not fully clear, you need to do this in a more holistic kind of manner as part of your strategic planning. And that's where you see some of the leading central banks, and I think India is doing the same, outlining it from the governor and the deputy governor as part of the larger strategic plan for the coming years to go. And that will also allow the central bank to allocate sufficient internal resources, because nothing is more killing in a central bank than if you have a really good project, but you don't have the resources, or they run short because it's not planned properly. Last, and I think definitely very important, as touched upon briefly already, the central bank should conduct a so-called cyber resilience and security posture assessment, preferably by an independent third-party specialist. And this would identify any gaps with the CBDC solution. That again is so critical, because as we reap the benefits of increased fintech developments, such as CBDC, the risks are exacerbated on the cybersecurity side as well. And I think that a lot of central banks are not fully aware of yet. Let me just stop right there.
Thank you so much for this comprehensive overview in terms of what perhaps the strategy from a central bank's perspective should be. Mr. Bhattacharya, I turn to you now. Your thoughts on the operational framework that may be necessary for CBDC issuance, especially from an Indian perspective. And the reason I also raised this question is to understand the role of perhaps the private sector in the CBDC issuance.
No, again, I mean, I think that's the core from what we heard from everyone, that operating ecosystem for the use of CBDC, for full functionality of the CBDC use, that's critical. I mean, obviously. So remember that in the payment space, say for instance, I mean, an entity largely official, but also with private sector holdings, like the NPCI, National Payments Corporation of India, I mean, has played a critical role in developing the very, very innovative payment systems that India has had, the National Financial Switch, etc. So, I mean, some equivalent organization, or maybe the NPCI itself doing that. And what the role, and you heard that. I mean, can the private sector do something where the design of the system and the overall regulation and monitoring is done by the central bank, but the actual operations are done by banks or some other institutions or whatever? I mean, that needs to be thought on what the roles are. But in terms of the adoption, so that's the operating ecosystem. Given the system, will people like you and me adopt that system? Will we get into that system? What are the key objectives for retail depositors, transactors, payers, receivers to get into the system? So that's an important thing. Remember that one of the key reasons for the development of the virtual currency, private currency networks is because of some degree of anonymity that those transactions provide. So Deputy Governor also mentioned that I mean, in the design of the retail CBDC segment, say for instance, Would you opt for a tokenized, a token-based access to the central bank CBDC architecture? Would it be accounts-based? So with a token-based, that's anonymized. I mean, that's as free-flowing as cash. So that would probably be adopted quicker, faster by at least a certain segment of the retail population. So things like this would need, and again, I mean, as Mr. Khan also mentioned, why should anybody adapt? Why should anybody offer such a system is what will be the critical things for actual rollout of the operating system.
Sure. Thank you so much. I think these are some of the issues that I wanted to specifically discuss with the panelists. At the time of registration for this webinar, we had also requested our audience to share in case if they had any questions for the panelists. We received a couple of them, so I'll just pick up like in light of the time constraints that we have, I'll basically pick up two because I think these are some questions that we can kind of discuss with our panelists. I'm not addressing this to any specific panelist, so either of you can please feel free to share your thoughts on this. One will be in terms of what will be the catalyst for CBDC adoption by retail users in India? And I think this is also an important question, considering that we have already talked about how India has moved in terms of the digital payments ecosystem. We already have a very convenient, fast payment ecosystem. So perhaps what will be some of the catalysts that might be necessary for CBDC adoption for retail consumers? Any one of you?
Mr. Khan, all yours.
Well, I'll do a couple of opening remarks, and then I'm really looking forward to hearing your thoughts also, Mr. Bhattacharya, because from the private sector perspective. And I think you actually alluded to them already just now when you talked about what are the objectives at the individual user level and the incentives, right? So let's assume that the overall objective is financial inclusion of a retail CBDC. Then how would you tailor it to make sure that those parts of the Indian population that currently are very cash oriented because of, let's say, more rural areas or, financial literacy aspects, how would you incentivize them? So then obviously you need to take design aspects into account, such as, what's the cell phone penetration rate among that part of the population? Do they have smartphones? If so, what kind of smartphones? Or is it still basic phones? Is there a continuous availability of, as the Deputy Governor pointed out, a high-speed network? Or is it lower network capabilities that are not always there? Similarly, the availability of electricity would tie into, just like the network availability, into offline capacities for such a solution. So, and then again, and I think especially if you look at India at the scale of what you're talking about, there is not, I think, one set of the population that you can earmark as, this is the group that benefits from a CBDC. Because that group is very diverse, whether it's because of regional or geographical restrictions, religious or cultural restrictions and preferences, rural versus urbanized areas, language issues and the availability. So in that sense, and then obviously the pervasiveness of electronic technology for those parts of the population. So I think, I really like the point that the Deputy Governor made. There is a sense of urgency and there's a sense of movement, but you need to do proper research into whom are you catering to and what are the demands at their end to meet your goal of financial inclusion. So, I mean, here also I'd like to hear your thoughts because you obviously are, in the private sector and see these developments more clearly.
No, so thank you. Very, very comprehensive. So the one little coda that I need to add is from the incentivization point. Obviously, what I had talked about earlier, the micro and the small borrowers in the system. So access to credit is a huge constraint. I mean, there's a very major constraint on growth, on development, on whatever. So that I think is one major. So the one part of the incentivization is just the plain costs. So I mean, as we discussed that, I mean, if it is possible to reduce the cost of intermediation, either through the cost of deposits or the cost of transferring funds, etc. And if that can actually translate into lower cost of credit, because credit to the small micro businesses is the cost is quite high, even in the formal sector. So that's a clear incentive that, I mean, if CBDCs can actually come in and as and when the credit ecosystem begins to adopt the CBDC, obviously that will transfer over into the more retail the deposit liability aspect of the CBDC, the usage, the payments of the CBDC. So the entry point will need to be credit, probably to incentivize this.
Sure. Thank you so much. Just, I think the last question that I had, Mr. Bhattacharya, maybe we can start with you on this one. The impact of CBDC on bank deposits during downturn or financial uncertainty, because I think this is also one issue that a lot of central banks are also trying to understand. Will it accelerate bank runs in case of a financial downturn?
Again, I mean, this is, I'll be very brief on this. So this is, again, not just a downturn, upturn, upcycle issue. Following from the discussion on bank disintermediation, the ability to better manage the cost of deposits in the system. Obviously, the tighter the spread of deposit rates at which banks can get, the tighter that spread will mean to more tighter transmission into monetary policy, which Deputy Governor also touched upon, in terms of what might be the implications of monetary policy. And obviously, I mean, the ability to move interest rates on deposits and credit during an upcycle or a down cycle, which is what monetary policy does, I mean, in terms of counter-cyclical approaches to cycles. And that probably will be very important for the behavior of depositors and creditors in an upcycle and down.
Sure, thank you so much. Mr. Khan, is there anything that you would like to add to this?
No, I think Mr. Bhattacharya and the Deputy Governor already covered it very clearly. I think, suffice it to say, central banks are doing a lot of research in this area. And, I think every day a new paper is published using one model or another. Obviously, models are never a full reflection of the reality. And I think that's why, the results coming out of these controlled sandbox pilots are extremely helpful to guide discussions further on the effects on financial intermediation, on monetary policy, the effectiveness of monetary policy operations. I think there's much more to see in the coming few months and years in this area.
Sure. Thank you so much. So with this, I think I'll end today's session. Now, I think our speakers have already kind of highlighted the opportunities presented by CBDC and, of course, some of the implications. It will have huge implications, no doubt, for the financial system. Now, the ultimate decision to issue a central bank digital currency obviously must be backed by evidence, by multidisciplinary research, I think, into the costs and benefits of CBDC issuance. But I think what we can all agree is that CBDC is no longer a topic of academic discussion now. It is an idea whose time has come. Thank you all so much for joining us. I thank the audience for their time, and I also thank my panelists for their insights and comments on such a pertinent topic for the financial system. Thank you once again for joining us. Have a great day, everyone.
Thank you, Shehnaz. Thank you very much.
Okay.